Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for November 23rd, 2013. We have a market that is in bullish normal conditions on an annual basis using weekly RSI 14. We're at 76 out of 100, so even deeper into overbought conditions. On a 10-day basis using the 10-day NDX, we are overbought at 105. 105 means that if you took the last 10 days trading range and took 5% of that range, that's how much higher the market closed on Friday's close compared to that previous 10-day trading range. So we have a breakout of that significance. Looking at the market Mosaic indicators, the percent stretch relative to the 200-day moving average is at 10.48%, white bullish. The slope of the 50 is still strong, green bullish at 0.65. ADX just tipped back above neutral at 25.0, so that's a round. It rounds up to 25. That's a market that is just beginning its strong trending upward move. ATR percentage remains at the low end of normal at 0.83%. The risk index is the moving average 30 of the VIX divided by the 10-period moving average. That comes in at 1.05. Because that number is greater than 1.0, we are in risk-on conditions, meaning it's favorable to hold riskier assets and look for growth. If we take that reading of 1.05 and look back over the last 5,000 days, and we take the standard deviation and find the z-score, that gives us a z-score of 0.48, meaning it's getting closer to the 5,000-day average. You can see the 90-day time series on this histogram. The risk index now is coming back towards historical norms. In the blended monthly rebalancing, no change to our holdings. You see them listed for the ETF 13, 22, and 32 portfolios. Those are all doing well this month. The next reevaluation is going to be on or about 1 December. In ETF 2, the current theoretical exposure is at 100%. The model portfolio itself will be at 100%. Taking a look in on today's readings for the 13 and the 32 ETF portfolio, you see almost everything is on a buy condition except for treasuries and real estate. The top three remain the U.S. indexes of technology, small caps, large caps, with the globals trailing. In the 32 ETF portfolio, which adds a few more focused and riskier assets, we have U.S. industrials, healthcare, and discretionary. The XLI, XLV, and XLY are all on buy signals. So that's where the current strength inside the U.S. is right now. Only on cash positions are the agriculture, long bond, U.S. real estate, commodities, and gold. Looking at the ETF Max, this is looking at 1,200 different ETFs through the same lens, and we're looking for current strength. Discount the VIX there because of a reverse split, and the quote server didn't backdate the price quotes. The leading candidates remain solar energy, Greece, small cap healthcare, Egypt, pharmaceuticals, aerospace and defense, etc. Now, what I look for are those that are on green on a 3-month basis and white on a 6-month basis. And what that means is you have an exceptional move in the 3-month period and a slightly above average move in the 6-month period. So that would give an indication of more recent acceleration in price growth. So that would make Greece to be very interesting. And I would be concerned now about the Golden Dragon and Global Wind, which are white on 3 months and green on 6 months. So they're starting to lose steam relative to the peer group. And I'll leave the rest of the list for you to review. Looking at the market health check now. The vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal red lines represent support levels that have held in the past and which, if violated, would provide price targets to the downside. We had the market break out to that 10-day new high, and this is an all-time high in the S&P. And what we're looking at here is a 10-day regression channel. That's the blue channel. 10-day regression line is the inside or the middle blue line. And then the channel is formed by the maximum excursion from the regression line during the look-back period. And it's still on track and leading into the higher ends, so potential more room above. The 30-period regression channel is the black channel. It's right on that 30-period regression line, so current price action is not overextended given the strength of the recent trend. And then the green channel, this longer-term one, is the 90-day regression channel, and that's all pointed up. So what we actually have here is the long-term trend is significantly up, as you can see by the slope of the green line. But then the black line and the blue lines have both accelerating their steepness, and so that means the trend up is getting even stronger. Even though the trend long-term is up, the shorter-term trends have greater strength, and so we want to be long and strong in this kind of a market. The dark shaded blue area is the 30-period Bollinger Band plus or minus 1. That's the river. The lighter blue shaded area is the floodplain, or the 30-period Bollinger Band plus or minus 2. And we use that to mark off the limits of the normal price action. We are in the upper band of the floodplain, so that's very healthy for the market. It's not running away yet, but it's still a very powerful upward trend. This sine wave looking black line is a time series of the slope of the 30-period regression line, and you can see in the blue circles where it's made significant turning points, and then also these three locations where it crossed the zero line for slope, where the slope is perfectly flat over the last 30 days. And we are in the upper end of normal here. It's starting to curl back up, and so the 30-day strength is up, the trend is up. These 3 days of selling caused that slope to weaken a little bit, but we're still in very good shape for the duration of this upward move. My estimate is that from 180 we can get to 190 just on a technical basis, given the strength of the regression lines and the fact that we've cleared previous resistance. You can see down in the lower right-hand corner the 200-day moving average, and we have about an 8.5% cushion before we would get into sideways channel, and that's basically the bottom of the regression line, the green regression channel. If the market fails here, we're looking for support at 177, then 176 and 175. If it fails below the Bollinger Band mean, that would be the first place for cause for concern. So we got two significant levels of support on the way up. Percent price oscillator is basically flat. It indicates that the market is fully valued here, and that a move in either direction of 5 to 8% would not be out of the ordinary. So 5 to 8% to the upside would be another $10 up to 190. On the downside, it would be back to 170ish, which would be the essentially the bottom of the floodplain, and that's the boundary of normal. Our protective stops, however, should protect us from an adverse move of that dimension. We are overbought on Williams percent R, but we can stay overbought for long periods of time, as you can see in previous excursions to the upside. So this is a long, strong bull market. You want to be long in the strongest sectors. Right now, that's the U.S. technology, small caps, industrials, pharmaceuticals, and discretionary. Looking at the ETF2 regional report, everything is on a buy signal compared to the 4-month moving average filter. So that keeps the model portfolio at 100% invested, 0% cash in the theoretical model. Bull normal conditions. S&P is better than the globals right now. The S&P at 62 is better than the globals at 61, so a hat tip to the U.S. Inside the U.S., the strength is technology at 64, then small caps at 64, S&P at 62, and then the mid caps at 62. The two strongest sectors are U.S. tech and U.S. small caps. The two weakest sectors are Latin America at 55 and emerging markets at 59. Looking at the world market model, everything in the U.S. is above average. Small cap growth is especially above average. China and South Korea in the green. Everything else in Asia is above average except Taiwan, Thailand, Philippines, and Indonesia. Canada above average. Mexico, Brazil below average. Everything Europe is above average. Germany and Spain especially strong, except Sweden, which is weak. Inside the business sectors, looking at the globals compared to their U.S. counterpart, what we have is the U.S. generally speaking, is is doing better than its global counterparts, with the exception of utilities, technology, and finance. No change to the leaders. ETF top 30 using the ETF2 lens. All the usual suspects: solar, golden dragons, pharmaceuticals, Spain, biotech, pharmaceuticals. Again, we're looking for green and white here. So green on strength and white on consistency would give us insights to be ready to exploit pharmaceuticals, healthcare, dynamic media, pure value, right X S&P, pure value, and this stack right here of the small cap growth, industrials, and insurance. So lots to choose from. Looking at the Dow 30 through the same lens, the two leading contenders for relative strength, Boeing and Nike, remain very strong. And then all these six in the green, under strength but white on consistency, are all beginning to emerge as leaders. 3M, General Electric, American Express, Pfizer, Visa, and Travelers. At the bottom of the stack, we have Cisco and IBM remain weak. Shifting to the daily report now, we have a triple screen signal in the VIX, channeling signal in Intel, 551W patterns in utilities and Boeing. These in the auto framer are all symbols that have better than a 2-to-1 on a simple retest of the 10-day high using a mechanical entry and a mechanical exit. No signals in channeling and overreaction. And you can see that we're in the volatility, S&P volatility, we're at the low end of normal. And the ADX, the bulls are firmly in charge and on the boundary of beginning strong trending behavior. So there's reason to believe, technically speaking, that a 5 to 8% move the upside is well within reason in the next 10 days. Looking at the Dow Tactical Summary, you can see Cisco, Caterpillar, Boeing, and Home Depot all test out better than 2-to-1 on the auto framer. The top 5 candidates for max pain range compression: Cisco, Caterpillar, Intel, IBM, and DuPont. Intel may be on sale due to the 5% loss on Friday, so we'll take a look at that chart in the weekend webinar. Looking at the ETF 30 Tactical Summary, the percent losers on Friday: the VIX, silver, real estate, oil, and agriculture. The winners: Brazil, Latin America, and XIV, which has had just a tremendous run here of late. VIX, silver, gold, all testing out better than 5-to-1 on the auto framer. The VIX is a triple screen, a channeling, and an overreaction. S&P utilities on a 551W pattern. Auto framer for your stats, for mechanical framing. Lots of good ones to choose from there. Looking at the additional indexes and indicators from the market Mosaic, you can see the 30-period regression line here in the blue. And then the polynomial regression line is accelerating away from that regression line. That's an indication of emerging new strength. You can see that the slope of that 30 is now within 1 SD of its 6-month average. It crossed the 10-period 5 days ago. That's an indication to be wary. That's really driven by the 3 days of selling in a row. That's the first time in the last 30 days that we'd seen that. So, although I like the breakout on Thursday and Friday, we got to remember that there has been some considerable selling as people are locking in profits in this strong bull. The rest of the charts just for your reference data. I'm not going to comment on them. What I'll show here on the z-scores of the 3 regression lines, the 10-period regression line pulled back at the edge of the +1 z-score and is now comfortably in the river, in the range of normal. The 30 has pulled back to the edge of normal, and the 90 has still been strongly moving up. This is a very favorable location for the next move up on a swing basis, because the 10 and the 30 have cooled off a little bit. It's found support, and while it was cooling off, all it ever did was just come down and test the edge of the river, as you can see right here. So this is very favorable for the market long term, and there's plenty of room for the 90, that long-term trend, to get well and to move up into the white. So we're getting ready for an extended next leg up based on that reading. Plenty of frog quality numbers better than 3 to choose from. Coal with a remarkable 4.0. We'll come back to these to the alpha stat here. What we've done is we've taken the time series of the 30-period regression line, subtracted the value of the S&P, so we get sort of a market neutral normalized reading. Inside the U.S., you can see the diamonds have actually been staging a relative comeback, and all three of the growth indexes, the NASDAQ, the mid caps, and the small caps, are all on the rise, and that's money flowing into them away from the large cap S&P and the Dow. So as the Dow and the S&P decay, you'll see that the risk-on candidates are doing better. You can see how gold has been punished here. Oil and blended commodities holding up relatively well. And that's everything I want to cover. This has been Ken Long talking to you from the New Century Fieldhouse in between games in our weekend tournament, as you can hear in the background. Thanks for hanging with me, and we'll see you on the webinar and in the chat room. Take good care.